Right. Good afternoon and welcome to our session for today. Right. I'm Eugene Olevison. I'll be facilitating this presentation. Right. Today I want to look at income taxes. Right. I'll be using the document that I sent to your different groups. I think earlier on, uh, before the class. Right. So basically, what we'll be talking about is the determination of income tax, disclosure of income tax. I will see where it takes us. We intend to make sure that we finish by 2:30. Very sorry for delaying, for disturbing your weekend. Uh, very sorry for that. Right. So I'll be using the document that I sent to you. And also note that all the documents that I'll be using, they will be sent in the groups. So don't worry about them. You will get them. And also don't worry about the recording, as the class is being recorded, and then the recording will be sent in the groups after the class. Right. So I'll send the recording after the class. Right. I will be using question 1 on the documents that I sent to you. Right. First of all, before I go to the question, I want to just do some brief explanations. Right. Can you hear me, my friends?
Yes, we can hear you.
Yes.
My
Yes.
friends. Thank you so much.
Yes, we can hear you.
Right. Thank you so much. Right. So what happens is normally financial statements are prepared according to IFRS, IAS, conceptual framework, and such. But the income tax expense that businesses have to pay to SARS is determined according to the Income Tax Act. Now you would find that we have incomes that we recognize in accounting when we prepare financial statements, which will not be recognized by SARS, which will not be taxed by SARS. We have expenses which we deduct when preparing financial statements, which are not deductible by SARS. Right. Now, because of that, there is a difference between our accounting profit and the taxable income, which is the amount on which SARS determines your tax liability. All right. So because of that, that's the reason why we now have to recompute our taxable income from the accounting profit and determine the current tax expense and also determine the current tax liability. So you'd find that in this module, normally we start from the profit for the year, for the profit before tax. And then out of the profit before tax, we take out all those incomes and expenses that were recognized according to IFRS and IAS, which are not recognized by SARS. And then we replace them with those that are recognized by SARS. Right. Right. So we take out all those transactions which are recognized by accounting, which are not recognized by SARS. We have to reverse them and take them out and replace them with those transactions that are recognized by SARS. Right, we've got two categories of those transactions. We have what we call exemptions. Right, exemptions are transactions which are recognized in accounting, but which are not recognized at all by SARS. For example, if you pay a fine for late VAT payment, late VAT submission of returns, and you are charged a fine by SARS. According to IFRS and accounting, it's an expense for the business, which will be deductible when determining a profit. But according to SARS, that expenditure cannot be deducted. You'd have things like dividends. If the company invests in other companies, in shares of other companies, and they receive dividends, those dividends in accounting, they will be included as part of income. But SARS will not recognize, will not tax that dividend, because the dividend is subject to what we call dividend tax. So those are what we call exempt items. So exempt differences are those items that are not recognized at all by SARS, but which are included when preparing financial statements. Then we've got what we call temporary differences. Temporary differences are recognized by both SARS and they are recognized by SARS and also by accounting, but there are differences in methods and timing. For example, if you have got prepaid income, you are doing the financial statements for 2023. According to accounting, that prepaid income is not included as part of your income for 2023. It will only be included in 2024, the year to which it represents. But SARS, according to their definition of gross income, gross income is an amount received by or accrued to. So as long as you have received an amount, it is regarded as income by SARS. So regardless of the fact that it's for 2024, if you receive it in 2023, you will be taxed in 2023. So there will be a timing difference. So those ones, we call them temporary differences. Differences for which they are recognized by both SARS and accounting, right? So now I want to try to answer this question. As I answer, I will be explaining to you what is important in each part of the question. Right. Sunage Limited or SunEdge is a manufacturer of solar power energy products. The following information of SunEdge Limited was presented to you for the financial year ended 31 December 2018. Whenever you are doing an accounting module, or be it you are looking at tax, auditing, management accounting, financial accounting, your financial year is a very important date because it will show a demarcation for some of the things that you're going to be dealing with. Right. Now, you then go to the required. The first part says calculate the correct profit before tax in the statement of profit or loss and other comprehensive income of SunEdge Limited for the year ended 31 December 2018. Right, my friends. When they say calculate the correct profit before tax, normally it means the profit before tax is already there. But that profit before tax that is there is wrong. That's what it means. That we have a profit before tax, but the profit before tax that is given is wrong. So you have to make corrections. There are two types of things that have to be taken into account. Number one, we have got omissions. There may be transactions which were supposed to be recorded, that is incomes and expenses, which were supposed to be recorded, but were not recorded. Then number two, we have got errors. There can be errors that were made when determining the profit. So when they say calculate the correct before tax, correct profit before tax, that means if there are any omissions, you now have to incorporate them. If there were any errors, you now have to correct them. And the marks of 2.5 marks should tell you that adjustments will just be 1 or 2 out of the whole question. Right. So now let's, so first of all, to answer this part, we have to read. And as we read, we want to know everything that is happening so that we already know. I'll be explaining to you some of the things as we go. Right. Other income. Right. In fact, first of all, there's an extract of statement of profit or loss. So that is the profit or loss that was prepared. And according to this profit or loss, there's 1,401,000 profit. But in these things, there might be omissions or errors. Right. Now let's read the additional information. Other income. The following items are included in other income. They are already included, these things. So you have to check if there is any error. Right, we have dividends received from listed investments amounting to 200,000, of which there's no problem in including that. Rent received from investment properties amounting to 25,000. The rent was received on 15 December 2017 in respect of January 28. So there's nothing wrong because our year is ending December. Although it was received in 2017, this rent related to January 2018. So there was nothing wrong in including it. So for now, there's no problem with that. Right. Then profit on sale of delivery vehicle amounting to 80,000. They referred us to 3.1. So we'll go to 3.1. That's when we'll see if there is any problem with that. Remember that our focus for now is to identify errors or omissions that were made in profit or loss. Our aim is not to calculate tax at the moment. Our aim is to correct that profit. So on number one, there is nothing that I see which is an error or an omission which has to be adjusted on our profit. So what if they say these things are included, you look for things that are included wrongly or which were included but were not supposed to be included so that you can include them in the correction. So far I can see that all those things that are on number one, they were correctly included, except maybe 3.1 we'll see when we go there. Number two, other expenses. The following items are included in other expenses. Credit losses written off amounting to 75,000. Sunage Limited made no allowance for credit losses in the prior years. The SA Revenue Services allows 25% of the allowance for credit losses as a deduction for tax purposes. Actual credit losses incurred are written off directly to the statement of profit or loss and other comprehensive income and not against the allowance for credit losses. Again, allowance credit losses that are written off, they are supposed to be included as an expense. Right, legal fees amounting to 50,000 that are not deductible for tax purposes. Right, even though they are not deductible, but for profit purposes, they are supposed to be included. Then depreciation for the year on delivery vehicles, including the delivery vehicle sold, amounting to 265,000. Right, so depreciation, they included it. Right. Now let's read our property plan and equipment number 3.1. On 31 December 2017, the carrying amount and tax base of delivery vehicles of Sunage Limited amounted to 805,000 and 630,000 respectively. On 30 June 2018, that is this year, a delivery vehicle with a cost price of 380,000 was sold. The carrying amount and the tax base of the delivery vehicle on date of sale amounted to 340,000 and 212,500 respectively. That is on the date of sale. The tax allowance for the delivery vehicles, including delivery vehicles sold, amounted to 262,500 for the year ended 31 December 2018. Right, they told us about the vehicle. Remember, let's not lose focus. For the part of the question that we are looking at, our interest is only to see if there are errors or omissions in the incomes and expenses included in the calculation of profit. So there's nothing on 3.1 to point to errors or omissions. All right, number 3.2. On 1 June 2018, that is this year, Sunage Limited purchased a new specialized plant for 1.5 due to an increase in the demand for the Ray Sun solar control panel manufactured by them. The installation cost of the plant by a German engineer amounted to 300,000. The plant was available for use as intended by management and brought into use on the completion of the installation on 1 July 2018. The plant is an estimated useful life of 10 years with no residual value. The SA Revenue Service allows a 40% deduction in the first year in which the plant is brought into use, and thereafter, a 20% deduction per annum for the next 3 years. In terms of Section 12C of the Income Tax Act, the tax allowance is not apportioned for part of a year and are written off according to the straight line method. Right. Now, this is where I want us to concentrate on. The acquisition and the depreciation of the new plants have not been recorded yet in the accounting records of Signage Limited at year end on 31 December 2018. So there is an omission of depreciation. Remember, depreciation is an expense, and expenses affect your profit. Our question wants us to calculate the corrected profit. So the profit that is there had not taken into account the depreciation. So we're supposed to now take it into account. Right, so let me just do this. Right. Calculation corrected profits of Signage Limited. For the year ended 31 December 2018. Right, we'll start with the provisional profit that is there. Right, provisional profit before tax. That is the profit before tax which is available before taking into account this omission. There's a profit before tax of 1,401,000. So they have 1,401,000. Right. Then we go to right. Let's say, can you just enlarge on your side? Because I think it's on your side. Because if I make it too big from what it is right now, it will be a problem. Just zoom on your side. Right. Now, I just want to write a few notes that maybe you should know. Calculation of corrected profits, corrected profit before tax. So you have to adjust for any omitted incomes and expenses when they say calculate the corrected profit before tax, and also adjust for errors made when determining the provisional profit. Right. And also adjust for new information arising after preparation. Which require adjustment. At a later stage, that's when you learn about events after the reporting period. So when they say calculate the correct before tax, this is what you'll be looking for. check on the question if there were any omissions and adjust for those omissions. Check if there were errors and correct those errors. And if there was any information that was gathered after the preparation, which warrants an adjustment and adjust accordingly. So like in this case, we're told that there's depreciation. This depreciation is on the plant. Right, now our depreciation right. I want you to see something. This plant was acquired on 1 June 2018, but it was only available for use on 1 July 2018. So although it was acquired on 1 June 2018, it was only ready or available for use on 1 July 2018. According to IAS 16, property, plant and equipment, you can only depreciate an item of property, plant and equipment from the date that it is available or ready for use. So although it was acquired on 1 June, we'll only begin depreciation on 1 July. Please note, not when it's brought, but when it's available or ready for use. So you should note that depreciation is provided from the date that the asset was ready or available for use. Right. So our depreciation, unless told otherwise, we just assume that they use the straight line. Right. The cost of the asset was 1.5, and installation cost was 300,000. Right. You should know that the cost of an asset includes all costs that were incurred to ensure that the asset was available for use. The cost of an asset includes all the costs that are incurred to ensure that the asset is ready for use. So it will include things like transport, when you're transporting to your premises, any insurance on acquisition, testing costs, installation costs. So the cost of this asset will be 1.5 plus 300, which is 800,000. And we're told that the useful life is 10 years. So we divide by 10. And there is no residual value. If there was a residual value, you could take the cost and subtract the residual value. So in this case, there's no residual value. So we would say right, would say 1.5 million the cost. Then we add 300,000 the installation costs. So all additional costs are included. Then we divide by the useful life, which is what? Which is 10 years. But remember that depreciation is apportioned. If an asset is bought or sold during the year, we have to take into account the period that the asset was ready for you, was available for use during the current year. Now, this asset was only available for use as from July 2018, and our year is ending in December. So July to December, we have 6 months. So this asset was only available for use for 6 months. So we're not using June, we're using July. So we'd say what? Multiply by 6 divided by 12. And what do we get?
Uh, 90,000.
90,000. And remember that depreciation is an expense. So that's why I'm deducting it. Right. Any questions on the treatment of this depreciation? Right. If there are no questions, then I will proceed. Then on 3.3, no other property, plant, and equipment were purchased or sold during the year. On number 4, we have current assets. Included in current assets in the statement of financial position of Sunage Limited on 31 December 2018 is prepaid security services. On 31 May 2018, Sunage Limited paid the security services relating to the period 1 June 2018 to 31 May 2019, amounting to 84,000. Right, so there's a prepayment, so there's no problem with that. So I think that's it, because the taxation, I'm not reading why. When they say calculate the profit before tax, we're calculating the profit before tax. So it's before we account for tax. So number 5 will not be relevant for now. So that means that's it. Then I can get my corrected profit before tax. Remember, we're calculating a profit before tax. That's why I didn't read everything to do with tax. That's our corrected profit before tax. Right. I will now come to part B. Right. Our part, Wiseman. The Wiseman, you can go on.
Yes, no, I'm with you. Thank you, Sam. I just want to check something here. You said the assets were acquired for 1.5, and for the installation was 300,000, and then we included the installation plus the amount to acquire the assets, and then we come up with 1.8. But I just want to make a different example, and then you tell me if those would form a part of the cost of that asset. Let's say we procure a container or a park home, ne? And then
Yes,
when they deliver that container, they have to put like a concrete on the floor to make sure that the container will be stable where they can put, where they're going to put it. That's and then they will tell us, okay, and then maybe they say it's a different company who can come and deliver and then install it. That amount, that for the concrete, that the company that they're gonna charge us separately, we have to include it as a cost of that assets.
Yes, Wiseman. All costs that are necessary to ensure that the asset is available for use should be added to the cost of the asset according to IAS 16.
Okay, no, thank
So
you.
all the costs that we incur so that we can make our asset available for use should be included in the cost of the asset. Even if they are even like in this case, the installation, maybe the company that sold the asset is different from the one that installed, you still include it. Even those that transport, maybe you buy from company A, transport is provided by company B, installation by company C. But when you record that asset in your books, the cost should be all those costs that were incurred to ensure that your asset is available for use.
Okay, no, thank you, sir.
Okay, right. Now I'll go to part B. Part B, it says calculate the deferred tax balance in the statement of financial position of Sunage Limited for the year ended 31 December 2018 using the statement of financial position approach. Indicate if the balance is a deferred tax asset or a deferred tax or a liability. Right, I know it will take a long time here, or we might even end here. But like when we start like this, I try to be as slow as possible because I want you to follow me and make sure that you don't get lost. Right, a deferred tax. Right. Right, calculation of deferred tax balance of Sunage Limited for the year ended 31 December 2018. Right. When you are doing your assessments, or you are writing your test, or you are writing your exam, they can ask you to calculate the deferred tax balance for the current year only, or they can ask you to calculate for the previous year only, or they can ask you to calculate both. Because sometimes they'll give you, let's say, the one for last year, then they just ask you to calculate for this year. Or they give you the one for this year, then they just ask you to calculate for last year. So always check for which years. Am I doing for both years, last year and this year? Or I'm only doing for this year? Because for us to calculate tax, we need both the one for this year and the one for last year. As you shall see, we need what we call the movement from last year to this year. For us to determine it, we should have deferred tax for last year and deferred tax for this year. Right. So you have to properly check on your question that did they ask about the deferred tax for last year or deferred tax for this year? Right. You can see that here they only said for 2018. You would find that when they talked about the tax, they might have given us for 2017. You can see here that the deferred tax liability balance on 31 December 2017 amounted to 43,500, which arose as a result of taxable temporary differences on delivery vehicles of 175,000 and a deductible temporary difference on the rent of 25,000. So are given for 2017. That's why they just asked us to calculate for 2018. Right. What is a deferred tax? Right. Deferred tax arises because the carrying amount of our assets or liabilities is different to the tax base of our assets and liabilities. Carrying amount is the value of our assets or liabilities according to IFRS and IAS, according to accounting standards. Those are the values of our assets or and liabilities according to accounting standards. That's carrying amount. Then tax base is the value of our assets and liabilities according to SAS, applying the tax rules. So there is a possibility that the values of our assets and liabilities will be different according to accounting versus SAS. When that happens, then we'll have what we call a deferred tax, because we'll have amounts that are included in our carrying amounts of our assets and liabilities that will be taxable or deductible in future. So there is a defer is to delay. There's a difference, a timing difference in recognizing decreases and increases in assets and liabilities between us and SAS. That's where the temporary difference comes in. Right. And when they say we should use them, if you can see, they always say in your exams, there are two approaches that we use, but they always ask us to use the statement of financial position approach. This is the one that we use in our modules. We don't use the other approach. That's why I'm not even going to talk about it. So when they say the statement of financial position approach, that means for each asset, we have to determine the following, right? Each asset or liability that has got a difference. Right. We'll have carrying amount of the assets. We'll have the tax base. We'll have the temporary difference. We'll have the deferred tax asset or liability. If it's liability, we show it as a negative. When I put liability in brackets, I mean if it's a liability, we'll show it as a negative. At the tax rate on 31 December 2018, you have to check what was our tax rate. The SA normal tax rate changed from 29% in 2017 to 28% in 2018. So it's 28%. So it's 28% at 28%. So you have to be very careful there because in your exams they can tell you about a change. Right. Right. You should know that when calculating deferred tax, we only include assets and liabilities in existence and the debt that the deferred tax is calculated. Right. So if there were assets that were there in 2017, but which are no longer there on 31 December 2018, they will not be required when calculating our deferred tax in this instance. We are only interested in assets and liabilities in existence on 31 December 2018. Because if an asset has already been sold or it's no longer there, it will no longer have any deferred tax consequences because it will no longer have any future tax consequences. The date that an asset is disposed of, both SARS and accounting remove it from the books. So there will no longer be any deferred tax consequences. So as long as an asset has been disposed or a liability has been extinguished, it will no longer have any deferred tax consequences. Of course, there are complicated issues which we don't deal with in this module, which can have that. But for this module, we know that there's nothing like that. So when we go back to the question, we'll only be interested in assets and liabilities existing on 31 December 2018. Right. Then another thing, a deferred tax arises where the difference is due to temporary differences. And there will be no deferred tax if the difference arises from exempt differences. So if the difference between the carrying amount and tax base is arising because of exempt differences, it won't have deferred tax consequences. So we'll not include it in the calculation of deferred tax. An example, let's say we've got an asset and they tell you that SARS does not grant at all capital allowances on that asset. But accounting is providing for depreciation. That is an exempt difference because SARS does not even allow capital allowances on that asset. So that will not result in deferred tax consequences because deferred tax was saying there's a difference in the period and timing, but both of us are accounting for the transaction. Right. Then we should know that carrying amount is the value of the asset or liability as determined according to accounting standards. Then tax base is the value of an asset or liability as determined according to tax laws. So we're saying according to SARS, right? And temporary difference It's the difference between the carrying amount of the asset or liability and its tax base. So I think this temporary difference here is the difference between this carrying amount and this tax base. Right. Then the deferred tax would be equal to the temporary difference multiplied by the tax rate. Right. So that's how we'll be determining these things. And then we should also note that for an asset, when the amount is greater than the tax base, is a deferred tax liability. And when the carrying amount right. And when there's a deferred tax liability, it means there are future. The transaction, the difference arises in future taxable amounts. Future taxable amounts. Whereas when there's a deferred tax asset, there will be a future deductible amount. There will be a future deductible amount. For a liability, if the carrying amount is greater than the tax base, there's a deferred tax asset. And if the carrying amount is less than the tax base, there's a deferred tax liability. That means there will be a future deductible amount. So that means there will be a future deductible amount, which SARS is going there will be a future taxable amount. Sorry, when there's a deferred tax liability, that means there's a future taxable amount. Right. Now, so we should always check: am I dealing with an asset or a liability to determine if there's a deferred tax asset or liability? Right. Let me go back now, and so now you have to go back to your passage and check all assets and liabilities that are existing on 31 December 2018, for which the carrying amount and tax base are different due to temporary differences. Those are the ones that we're looking for. So start from the beginning. Right. The first asset or liability comes from here, but this one I'm not going to talk about it. Why? Because this was a prepayment in 2017. We're now in 2018. It's no longer a prepayment. Remember, as I told you, that you have to look for prepayment. You have to look for assets and liabilities at the reporting date. So this rent was a prepayment in 2017, but 2018 it's no longer a prepayment. Right. So then I will come here. Credit losses. There is 75,000. Sunaj made no allowance for credit losses in prior years. So there's an allowance for credit losses. But SARS allows only 25% of the allowance of credit losses as deduction for tax purposes. We have a timing difference here. We allow 75,000 now, but SARS only allowed 25% for now. That will be a temporary difference, because when finally we lose those debts, SARS will allow the rest of the debts. So that's why we call it a temporary difference. So there is a temporary difference here. So we have our allowance for credit losses. We have 75,000. Right, what do we get?
$18,750.
$18,750. Right, so that's $18,750. Right, that will be our tax base. Right, now in allowance for credit losses is a provision, which is a liability. In allowance for credit losses is a liability, and the liability's carrying amount is more than the tax base. If you still remember what I told you here, when a carrying amount of a liability is greater than the tax base, we've got a deferred tax asset. So if there's a deferred tax asset, right, that means there's a future deductible. Because there's a future deductible, we have to show it as a negative here. Right, then our deferred tax will multiply by 20%. Right, so that will be a deferred tax asset. Remember, I said a deferred tax asset is a future deductible. That's why the temporary difference, we show it as a deduction here, and then we show it as a positive here, because that will be a future deductible. Whereas a deferred tax liability, it shows a future taxable amount. That's why we show it as a positive here and as a negative there. So that is our allowance for credit losses. Right. Right, then the next one, we have a property, plant and equipment. On 31 December, the carrying amount in tax base of delivery vehicles of Sunage Limited amounted to 805,000 and 630,000 respectively. On 30 June 2018.
Sorry, sir.
Yes.
I want to ask, where does the 15,750 for the
Remember, I
deferred
told you
tax?
that you multiply by the tax rate. Yeah, the formula, you multiply this times 20%.
Isn't it supposed to be 18,750?
I can't hear you.
Isn't it supposed to be 18,750?
It's 18. If you say 56 times 28%.
No, it's correct. It's 15,750.
Oh, now I understand. Okay.
You multiply your temporary difference times the tax rate.
Oh, okay. Thank you.
Okay, thanks. Right. We are now told that the carrying amount in tax base of delivery vehicles. Okay, thank you, Kaniso. Right, we are told that the tax base amounted to 805 and 630. This is 2017. On 30 June 2018, a delivery vehicle with a cost of 380 was sold. The carrying amount in the tax base of the delivery vehicle on the date of sale amounted to 340 and 212,000 respectively. The tax allowance for delivery vehicles, including delivery vehicles sold, amounted to 262,500 for the year ended 2018. Right. So now we need the carrying amount and tax base on 31 December 2018. Right. Now let me just show you the a carrying amount of delivery vehicles on 31 December 2018. Right. Please, guys, you use this formula if we know our carrying amount from last year and we know the movements that happened during the current year. That's when we use this formula that I want to give you here. Right. You would start with the carrying amount on 31 December 2017. Right. We are told that the carrying amount on 31 December 2017 was 805,000. This was the carrying amount. So 805,000. Right. We then add any additions of which we don't have any additions. There were no delivery vehicles sold during the year. Right. Then we say less depreciation for the year. Right. And we know that our depreciation for the year were given. The depreciation for the including the delivery vehicle sold, we're told that it's 265,000. So 265,000. Then less carrying amount of disposals on date of sale. Right. We have here that the carrying amount and tax base of the delivery vehicle on the date of sale was 340,000. So it was 340,000. Mam Kelly, that's where I am. So 340,000. Right. So we then subtract the 340,000. This will give us the carrying amount at year end. So that's our carrying amount of the vehicles at year end. Any questions there? Right. So this will be our carrying amount 200,000. Then we calculate the tax base the same way. we'll have the same way tax base at beginning of year. Right, our tax base at the beginning of the year, you can see that our tax base was 630. Additions at cost, of which we don't have additions. Less capital allowances. During year. Right, we are told that the capital allowances for the year, the tax allowance for the delivery vehicle, including delivery vehicle sold, was 262,500. Right, less tax base of disposals on date of sale. We are told that the vehicle which was sold, its tax base on the date of sale was 212,500. So which is 212,500. Which will give us a tax base
$155,000.
155,000. So we have 155,000 here. Right. So that means now we know that our carrying amount of the vehicle is greater than the tax base. Delivery vehicle is an asset. And from here, when the carrying amount of an asset is greater than the tax base, we have a deferred tax liability, which is a future taxable amount. So we'll have here and to get that final figure, we'll find 28%.
$12,600.
So when it's a liability, we put it as a negative on the last column and a positive here. It's a future taxable amount. Right. Before I proceed, any questions on the delivery vehicle? No questions. Right. Then we move on to the next asset. We have the plant. We are told that on 1 June 2018, Sun Edge Limited purchased a new specialized plant for 1.5 million due to an increase in the demand of the Ray Sun solar control panel manufactured by them. The installation cost of the plant by a German engineer amounted to 300,000, of which I said that we have to add that to the cost to make it 1.8. The plant was available for use as intended by management and brought into use on the completion of the installation on 1 July 2018. Right. So you should know that accounting begins to provide for depreciation on the date that the asset is available already for use. SARS begins to provide for depreciation from the date that the asset is brought into use. Note those two differences. Accounting, when available already for use. SARS, brought into use. In this case, the date is the same. It was available and brought into use on the same date, which was 1 July. So even SARS will start from 1 July. Right. But you should know that SARS, for some allowances, they don't apportion. When we say they don't apportion, like in this case, this plan, remember, was available for 6 months. SARS will just take it as a full year for some. So we'll have to check instructions. Right. So let's start with our plant. Plant carrying amount. Right, for plant, we don't have to do what we did on the vehicles. Why? Because we didn't have any plant from last year. The plant only, so if it's acquired during the current year, we simply have to say our cost, which is 1.5 plus 300,000, which is 1.8 million. Less depreciation. There's no accumulated depreciation. The depreciation is just the same as the accumulated because we are in the first year. Our depreciation, we already have it. Remember, we calculated it on when we were answering the first question. It's the 90,000 here. So that means our carrying amount on 31 December 2018 that's 1,710,000. So to come here, our plants 1,710,000. Right. Then we'll have our tax base. Right. We'll have our cost, which is still 1.8. Then capital allowances will not be the same as depreciation. We have to find out how SARS are granting the capital allowance. Right, we are told here that the SA Revenue Service allows a 40% deduction in the first year in which the plant is brought into use, and thereafter a 20% deduction per annum for the next 3 years in terms of Section 12C of the Income Tax Act. The tax allowance is not apportioned for part of a year and are written off according to the straight line method. So we are in the first year, so it will be 40% our depreciation. Number two, they said the tax allowance is not apportioned. So we're not going to take into account the fact that it was used for 6 months. So we simply say 40% multiplied by 1.8. What do you get?
720,000.
700 what?
And 20,000.
Thank you so much. Then we get our tax base.
Sorry, sir. Sorry.
Yes. Yes.
Let's say
go
on
on.
this, let's say on this statement, that statement that says the tax allowance is not apportioned for part of a year. If this statement was not there, were we going to calculate for 6 months or still we're going to calculate for 12 months?
No, if they don't say it's not apportioned, we would use we would multiply by 6/12.
Okay, thank you.
What's happening with the wrong answer there? I think that's what we're explaining, that we don't multiply by 6/12 because of this. Not apportioned. when they say not apportioned, so you don't take, that means SARS are not taking the months into account. Even part of a year is taken as a full year. So there's no need for the, so whenever they say not apportioned, like what my sister was just asking, you don't take part of the fact that it's part of a year. You just take it as a full year. Okay, thank you. All right. So then we'll now say that would be 1,080,000 would be our tax base. So we'd say 1,080,000 here. Right. Let's remember that this is an asset. Because it is an asset, when the carrying amount is more than the tax base, there's a deferred tax liability, remember, which is a future deductible. Right. So we'd say which is a future taxable income. So we'd say then we find 28%.
$176,400.
Right. So that will be our deferred tax. Any questions on the plan? So please be very careful about these nitty-gritties, like ready for use when, available for use, brought into use. Like in this question, they could have said brought into use was 1 August. But anyway, it was not going to affect because they said not apportioned. So this is like not apportioned. Be very careful with them. Right. Then, so that's it on the plant. Then let's check if we've got other assets. Right. Included in current assets in the statement of financial position of Sunage Limited on 31 December 2018, which is right, is prepaid security services. On 31 May 2018, Sunage Limited paid the security services relating to the period from 1 June to 31 May, amounting to 84. I think those who do tax, you might know that maybe if you started this year, maybe you've not yet done it. When there is a prepayment, a prepaid expense, as long as the prepayment is for a period of less than 6 months, or the prepayment is for less than 100,000, then it can be deducted in full in the current year. Like in this case, obviously the prepayment is less than 100,000, considering that the total amount was 84, which is less than 100. And also the prepayment was only for 5 months. Remember, our year is ending on 31 December 2018. So this payment was up to May 2019. So there are only 5 months outside our period. That is 1 January 2019 to 31 May 2019. So would have.
Can you please repeat what you just said about prepaid?
I was saying, when it comes to SARS, if you have a prepayment, it can be deducted in full, as long as the prepayment is for a period of less than 6 months, or the prepayment amount is less than 100,000, is 100,000 or less. So this prepayment, according to accounting, is recognized as a prepayment, but according to SARS, it will be fully deductible in the current year. So because of that, there will be deferred tax consequences. So accounting will have prepaid security expenses. Oh, they say here, we know that this payment, the prepayment is only for 5 months. You should understand that, because our year is ending 31 December. So the prepayment is for 1 January 2019 to 31 May 2019, which is 5 months. So 5 months out of this 12. Remember, this was paid for 12 months. 5 out of the 12 is the prepayment. So we'd say we can just calculate it then. 84,000 multiplied by 5 divided by 12. What do we get?
$42,000.
The tax base is 0, because SARS will fully deduct the 84. because the prepayment is less than 100,000 and it's for a period less than 6 months. So SARS will deduct the full 84 as an expenditure.
I get 35,000. I'm not sure.
I'm also getting 35,000.
I've got 35.
Yeah, 35,000 is the correct
Thank
answer.
you,
Sorry
guys.
about that. 25.
I think our
Sorry.
colleague had used 7, the other 7. Thank you so much. It's okay. Thanks. Right. Then our temporary this is an asset. And when carrying amount, prepaid expense is an asset. When carrying amount is greater than tax base, we've got a deferred tax liability. Right. So we have a liability. So left 35,000. Can you multiply by 28%?
9.8.
Right. This will be our deferred tax. So we can conclude that our deferred tax, considering that this is a negative, the overall, we can say this is a deferred tax liability. We will check here if this is negative here. If it's positive, it's a deferred tax asset. We are saying since SARS have deducted the full amount, that means they don't have a prepaid expense in their books. Because they've already deducted the full amount because it's less than 100,000 and the prepayment is for less than 6 months. So SARS don't have a prepayment in their books. That's why it's 0. I always share, after the class, I will share the spreadsheet. Right, any questions on the calculation of the deferred tax? Right. I don't want to rush through over the other parts because I need to properly explain. So please, guys, review A and B, and then when we meet to make sure that we do the C, D, and E, so that we know how to do the note, those journal entries, and stuff like that. Then number 2 will be your homework after the number 1. Right. So our next class will be on. We'll have the class on Tuesday at 6:15 in the evening. We'll have a class on Tuesday at 6:15 in the evening.
Sorry,
thank you
Eugene.
so much.
How did you get the temporary difference? Because I'm getting a different number. I'm getting millions here.
What are you getting?
I'm getting 1,585,000. Or am I wrong?
Where? Yeah. It's impossible to get 1 million with these figures. Can you just look at those figures? It's impossible.
So we say negative 56,250
Yeah,
plus
plus 45,000.
445.
Plus 45,000 plus 630,000
Oh,
plus
maybe
35,000.
because I see my mistake. I
Okay.
have 450
Okay,
plus
that's fine.
45,000 plus 630,000.
Yes, plus 35,000.
Okay, thank you. I saw my mistake. Thank you.
Okay. Thank you so much. We'll discuss in your groups. Enjoy your weekend. So we'll continue on Tuesday at 6:15. The recording will follow later. I've had the classes in the afternoon. So after those classes, then I will sort the recording. Don't worry. You get the recording and the spreadsheet later today. Thank you so much.
much.
Enjoy your day.
Thank you.